Now let's try and understand one of the very important current affairs issues that keeps on popping up every now and then, the concept of surplus transfers. Now, before looking at what points have been given here, let's look at certain important points. First, RBI is owned by whom? Government of India. By now, it must be very clear to you, RBI is owned by Government of India. So, whatever are the profits of RBI, the profits generated by RBI should belong to whom? Should belong to Government of India. And understand this generally, whenever you look at a corporation or a company like this, the company will make certain profits, and these particular profits, part of this, are distributed amongst the shareholders. Now suddenly you will have a question, sir, what do you mean by shareholder? The concept of shares will be discussed in elaboration under the concept of financial market. As of now, simply understand this. Shareholders are nothing but owners of a particular company. The second example, imagine here is a company XYZ and it has issued 1000 shares in the market. Out of these particular 1000 shares, if you purchase, let's say 200 shares of this same company XYZ, then you are 20% owner of the company. Is it okay? You are 20% owner or equity holder of the company. That is the concept of the shares, which we will discuss again, do not worry, under the module of financial market. So in case of the companies, shareholders will get the benefits in the form of returns out of the profits which are earned, and these particular returns which are given to the shareholders, this is called as a dividend. This is the second point. Remember the technical term, it is called as dividend. Third, we are talking this about a company. In case of RBI, no doubt it is also making profits, but strictly speaking, it is not a commercial entity. Is it okay? Strictly speaking, it is not a commercial entity. The role of RBI is different rather than only earning profit in the market. So what we do is, we'll basically look at this particular concept of RBI. It will also incur certain expenditure. It will also generate certain amount of revenues. Okay, it will incur expenditure. It generates revenues. If the expenditure is higher than the revenue, if I'm spending more than what I'm earning, this is called as a loss. Is it okay? This is a loss. And if it is vice versa, that is revenues are higher than expenditure, this is nothing but basically a profit. It is same applicable for companies, same applicable for even RBI. In this particular case, assume that, and in reality it happens, RBI is incurring expenditure which is lower than the revenues generated by RBI. Some of you will raise a question, sir, what is the expenditure, what is the revenue for RBI? I'll show that also, please do not worry. Let's understand the basics here, then we'll apply it. So RBI revenues are higher than RBI's expenditure. So RBI is making certain profit. Now because RBI strictly is not a commercial entity, rather than using the term profit, we will use the term surplus. And whenever RBI generates this particular surplus, part of the surplus, is it okay? Imagine this is a surplus here. Part of the surplus, it will transfer to its balance sheet, and remaining it will pay to Government of India. Now what is this concept of a balance sheet? I'll give you two basic ideas here, just understand. For UPSC this will be more than sufficient, but suddenly I use the term balance sheet, you might get confused. What is a balance sheet? For every company, it is required to prepare two financial statements. Every company, there's a requirement that they will have to prepare two financial statements. One will refer to this as a balance sheet. Second one is referred to as profit and loss account. P&L account basically refers to profit and loss account, or else they will also use the term income statement. Generally what happens is, under profit and loss account, whatever is the expenditure incurred by this particular company and whatever is the revenue generated by the company are listed. Okay, that is basically, let's imagine a particular company is there. It is manufacturing a good and selling the good in the market. Now, before selling the good in the market, the company will incur expenditure. It has to purchase raw materials. It has to purchase machines. It has to purchase electricity. It has to pay for transportation, labor, etc. So all of these are mentioned under expenditure account or expenditure column. And once the goods are manufactured, these are sold in the market, the company will collect revenues. Right? I'm using the term revenues. Some of the books will use the term turnover. Sales and revenue. Both are one and the same. So the company manufactures a good, and for that we'll have to purchase raw materials, and then we'll have to sell the good in the market, generates revenue. So assume the revenue is higher than expenditure. This is called as profits, or specifically these are called as book profits. Again, from book profits, certain adjustments are there, and we will arrive at the taxable profits. You don't have to worry about it. Now have a look at this. Out of these particular profits, part of the amount will be transferred into the balance sheet. Right? That is what is done by RBI. Now what is this particular balance sheet? Balance sheet basically will list out what are the assets of the company and what are the liabilities of the company. Is it okay? What are the assets of this particular company? What are the liabilities of this company? For example, if a particular company has, let's say, a loan to repay, if a particular company has issued bonds in the market which they need to repay, if a particular company owns a certain manufacturing facility, machines are there, all of these are basically listed in the balance sheet. Then Now, this particular concept, right, of representation of a financial statements, right, basically in the form of assets and liabilities, is referred to as a balance sheet. Expenditure and revenue is called as a P&L account. Same thing is done even by RBI. It will list out what expenditures it has incurred. It will also list out what kind of incomes or revenues has been generated by this particular RBI. And the difference between that, assuming that revenue side is higher than expenditure side, it is the profits of RBI. Rather than using the term profit, what we simply use is concept of a surplus. For a simple reason, RBI, strictly speaking, is not a commercial enterprise. It is not a commercial entity. It is an entity which is owned by the government, which is mainly a regulator. And in the process of regulation, providing certain services, etc., it is generating profits, which we use the term surplus. Okay? Now, have a look at this. This is a contention between Government of India as well as RBI. Let's take a simple example. Imagine RBI has generated a surplus of 100 crore rupees. Okay? Out of this 100 crore rupees, if RBI transfers, let's say 60 crore rupees into the balance sheet, then how much is left out to be transferred to Government of India? 40 crore rupees. The Government of India says that the amount that you are transferring in your balance sheet is very, very high. And because you are transferring huge amount within your balance sheet, the amount that I am getting is very, very low. Is the logic okay? Because the surplus is an amount. Out of this, if majority is transferred to, let's say, balance sheet, remaining amount will be lower. And this lower amount will be given to government. And the argument of the government is, right, you are keeping a lot of money in the balance sheet, you don't require so much of money. So reduce the transfers to this particular balance sheet so that I will get more and more money. I am the owner of this RBI, so the profits should come to me. So argument here is, let's say rather than transferring 60 crore rupees, transfer only 30 crore into your balance sheet, right? I will be receiving because of this 70 crore rupees. That is the argument of the government. Now, two things here. Why is Government of India saying this? And second, why is RBI transferring the money into the balance sheet in the first place? In the balance sheet, there are different types of accounts, right? In the balance sheet, there are different types of funds or accounts which are maintained by RBI. For example, there is CGRE, the Currency and Gold Revaluation Account. There is a fund which has been set up to take care of the contingency itself. So there are different types of funds or accounts which are maintained by RBI, and under this, these particular funds are transferred by RBI. And the argument of RBI is very simple. Imagine there is a crisis in the banking sector. That is, in India's banking sector, imagine there is a crisis. And when there is a crisis in the banking sector, I should be able to provide certain financial support to the banking sector in India. And for that particular purpose, I am maintaining these particular reserves. That is the argument of RBI, and that is the precise reason why they are transferring so many funds within the balance sheet. And the argument of the Government of India, counter argument is, one, whatever funds you are transferring is very, very high. Second, if you compare how much RBI is maintaining with, let's say, Federal Reserve of USA or the central banker in European countries, RBI maintains a huge amount of reserves. That is the counter argument of Government of India. So there is a friction, or there was a friction between both the Government of India as well as RBI. To address this particular friction, a committee was set up. The committee to look into the Economic Capital Framework. Remember the name here? The committee to look into Economic Capital Framework, ECF. Okay? Economic Capital Framework of RBI. Right? Basically, it was to give recommendations as to what formula should be used, right? Out of the balances or out of, let's say, the surpluses, how much should be transferred into balance sheet, how much should be transferred, right, to Government of India. Formula was supposed to be provided. That is basically the idea of a Economic Capital Framework. And second thing, understand this, rather than using the term Economic Capital Framework Committee, they will also use the term Bimal Jalan Committee. Bimal Jalan is the person who headed this particular committee. Hence, the committee is also known by the name of the chairperson of this particular, or chairman of this particular committee. And just a nugget here, Mr. Bimal Jalan is a former RBI governor. So these are some of the points. What recommendations have been provided? We'll have a look at it, but before discussing the recommendations, how does RBI spend money? From which source? In case of earnings, that is basically the sources from which RBI earns money, I've listed some of them here. For example, last time, basically in the earlier slides, we have discussed the concept of a forex reserves. And in case of forex reserves, I've told you that RBI holds huge amount of forex reserves, and these particular forex reserves will be used by RBI to spend or to invest. More appropriately, the term used will be to invest in, let's say, the government securities. Not only in the government securities issued by the Government of India, the RBI is also allowed to invest in some of the other government securities issued by the foreign companies. So it will hold huge amount of the G securities on which the RBI earns. And this is allowed to RBI under Section 17 of RBI Act of 1934. Remember this. Section 17 of RBI Act of 1934 basically regulates how RBI can invest the funds that it has actually collected. So first thing, RBI will be earning out of its foreign currency assets because it invests in government securities. It will invest in securities issued by the foreign governments, etc. Second, understand this. As usual, right? I've already covered this. Rupee denominated bonds are held by RBI. On this, it will earn certain amount of interest. Third, it will lend to banks. We have already seen certain types of instruments which are used by RBI. It will lend to the banks, and on this, it will earn certain rate of interest. It will also basically manage some of the functions such as borrowings of the state government as well as central government. I hope you remember the concept of open market operations, where we have discussed that RBI will issue, that is auction, the G securities which are issued by the central government as well as state government. It will repurchase, right, these particular G securities. For having provided these kind of functions, RBI will charge some amount of money on both the central government as well as the state governments. And finally, seigniorage. In simple terms, seigniorage basically refers to the difference between the value of the currency and the cost that is incurred to print the currency. For example, imagine I will hold a 500 rupee currency note in my hand. Now, to print this particular 500 rupee currency note, RBI would have incurred certain expenditure. Let's take a simple example, 50 rupees. To print this particular 500 rupee currency note, imagine to print this particular 500 rupee currency note, RBI has spent 50 rupees. But after printing the currency note, what is the value provided on this? The value provided on this is 500 rupees. So the difference between this, that is the cost of printing, and the value of the currency note is the concept of a seigniorage, and that becomes a part of the earnings of RBI. Done. So these are some of the ways through which RBI earns, right, in the market. Now what about the expenditure? Where all RBI spends money for printing of currency notes? Right, for printing this particular currency notes, RBI has to spend money, right, for expenditure related to staffs. Let's say, for example, salaries which have to be provided. So staff related expenditures. It also pays a certain commissions to various banks which are involved in the transaction on behalf of the government. For example, exchange rates, remittances, services which are provided by these particular banking, let's say banking branches across India. And when they provide these kind of services, they will be paid certain amount of commission which has to be paid by RBI here. So these are some of the expenditures which are incurred by RBI. So on one side, there are expenditures, and on the other hand, there are revenues or incomes. And in case of RBI, the revenues are higher than the expenditures. Hence, there is a scope of a profit or a surplus here. And this particular issue of a surplus, to basically discuss how the surplus has to be transferred between the center and the RBI. Already mentioned that the government of India set up the committee that is basically Economic Capital Framework Committee, or else Bimal Jalan Committee. What are the recommendations of this particular committee? First and foremost, it recommends that the CF stands for contingency fund, and RBI maintains different types of funds already as mentioned in the balance sheet. On one side, there will be representation of liabilities, and on the other hand, there will be representation of the assets like this. And the different types of funds will be mentioned or will be listed in case of the liability side like this. There are different types of funds. Right, so one type of a fund which is very important for RBI is a contingency fund, and the objective of setting up this particular contingency fund is to ensure that in case of emergency, in case of a need, in case of a contingency, RBI will have a certain pool of funds from where it can use this particular money to address this particular emergency or contingency in the market. So what this particular committee recommends is, one, have a look at this. The contingency fund, the amount that is kept by RBI within this particular contingency fund should not be more than 5.5% to 6.5%. And RBI, that is the Central Board of Directors, has accepted this particular recommendation, and we are using, let's say, 5.5% currently. What does it mean? Understand the logic here. In case of this particular recommendation, let's say this is the balance sheet, and the total value of liabilities is 100 crore rupees, and the asset will also be 100 crore rupees. Remember this. Balance sheet essentially means both the sides, that is the liability side as well as the asset side, the total value should remain same. So if the total value of the assets is 100 crore rupees, then the committee recommendation is the amount that is kept by the RBI under the contingency fund should not be more than 5.5% of the value of the asset. It essentially means the value of the asset is 100 crore rupees, and 5.5% of this will be how much? 5.5 crore rupees. Is it okay? 5.5% of 100 crore is nothing but 5.5 crore rupees. So the total amount that RBI is allowed to keep within this particular contingency fund should not be more than 5.5 crore. How is it applicable now? Let's take a simple situation here. Imagine RBI has earned surplus of 100 crore rupees. Now it has to distribute between the government as well as transfer some amount to RBI's balance sheet. Now how it will be done? Imagine within the balance sheet, the CF amount is only 3 crore rupees. Okay? The CF amount is only just 3 crore rupees. What does it mean? You are allowed to hold up to 5.5 crore, assuming the asset side is 100 crore rupees. You are allowed to hold up to 5.5 crore rupees. But how much do you have right now? Only 3 crore rupees. Out of this particular 100 crore rupees, RBI is allowed to transfer 2.5 crore rupees right to the contingency fund. Is it okay? Out of this particular 100 crore, you are allowed to transfer 2.5 crore rupees into this particular contingency fund, so that you will be meeting this particular slab of 5.5%. First point. Now you are basically saying, sir, you are taking a number less than 5.5 crore, hence you will transfer. What if already in the CF there are 7 crore rupees? Okay, there are 7 crore rupees. In that particular case, what will you do? Then the committee says, what is your limit? Your limit maximum will be how much? 5.5 crore rupees. But how much money do you have in the CF right now? You have 7 crore rupees, which essentially means out of this a surplus of 100 crore rupees which is earned by RBI this year, nothing shall be transferred into the contingency fund. Nothing shall be transferred. Rather, we will take 1.5 crore rupees out of the CF for transfer to the government. Is it okay? Rather than transferring out of the surplus, what we are going to do is, we are going to take out 1.5 crore rupees out of this particular CF which is already present and transfer this to Government of India. Why? The limit that RBI is allowed to hold will be 5.5% of the total value of the asset. If it is higher than 5.5% of the total value of the asset, excess whatever is there, simply transfer it to the government. This is the recommendation of the committee, Bimal Jalan Committee or Committee on Economic Capital Framework of RBI. This is the first one. Second one, the total value of the reserves. That is, I stated that under the liabilities side, different types of funds are kept. And rather than using the funds, he is using the term reserves here. So the total value of these particular funds should not be more than 20 to 24.5% of the total value of the asset, which essentially means, I stated there is a CGRE, there is a CF, right? There is a IDA, different types of accounts are there. The total value of money that is kept by RBI under all of these particular accounts should not be more than 20 to 24.5% of the total value of the asset. And that is another very important recommendation of the Bimal Jalan Committee. Third very important recommendation, the committee also has recommended that periodically, that is once every 5 years, this particular framework should be reviewed. And next very important recommendation, the financial year or the accounting year of RBI is different or was different, and the accounting year for Government of India is different. What do you mean by this? The financial year for RBI will basically start from the 1st of July and will go on till the end of June. Right? For example, it will start from 1st of July of this year and will continue till end of June next year. That is the financial year or accounting year for RBI. It was there until very recently. Whereas for Government of India, the financial year or accounting year will basically start from 1st of April and will end on 31st March of next year. So have a look at this. There's a difference between the accounting year for the RBI as well as for Government of India. And what is the problem with this? Right? What will happen if there's a difference in the accounting year? I stated that first point, Government of India owns RBI. So out of the surplus, some amount of money has to be given to Government of India because Government of India owns, and this is basically nothing but dividend which RBI will pay to Government of India. And that's the second point. Third point, the problem here is until the full financial year is over for RBI, it will not know how much surplus they are going to earn. Because until unless the full year is over, that is accounting year is over, how can you know how much revenue you are going to generate? How much expenditure you are going to incur? How much profit or surplus you are going to generate? You might have an idea, but you are not sure. Final number could be something else than what was your estimate. So because there is a difference in the accounting year of RBI as well as Government of India, it creates a problem with respect to transfer of a surplus to Government of India. Where generally for Government of India, the accounting year starts from 1st of April and ends on 31st March of next year. And in that particular year, government announces a budget. And in the budget, government will tell you how much expenditure the government will incur and how much receipt or income the government is going to generate. And one type of income that is listed by the government under this particular head is basically the surplus or the dividends that it will earn from different institutions or different companies that the Government of India owns. For example, there are CPSEs which are owned by Government of India. So part of their profits they will have to transfer to Government of India. So Government of India would have made a provision as to how much money they're expecting this year in the form of the surplus or dividend. Let's take a simple example here. Imagine for the year 2022 you are talking for this. So for the Government of India, the accounting year will start from 1st of April, let's say 2021, and will end on 31st March of 2022. This is where the account books of Government of India are closed and will start next financial year. But on the other hand, have a look at for RBI, it starts on 1st of July and will end with the end of the June. So RBI will be only able to find out how much exactly the amount of surplus they have earned only after the end of June, right? And they will transfer this in the form of a dividend, in the form of a surplus to Government of India after June is over. But for Government of India, this particular year is already over. So it creates a certain problem with respect to transfer of surplus. And to address this, there is a concept of interim dividend. What is the interim dividend? RBI, before the end of accounting year of Government of India, will announce a certain amount of a dividend or surplus. Is it okay? The RBI's accounting year is not yet over. It will only get over with the end of the June. But even before the accounting year for Government of India gets over, RBI announces a certain amount of a dividend, certain amount of a surplus transfer to Government of India. That is called as interim dividend. What this particular committee says is, the issue of interim dividend arises only because there is a difference in the accounting year for government as well as RBI. What if both follow the same accounting year? What if both of them have the same practice of a financial year? This particular concept of interim dividend or announcement of interim dividend will not be required. That is the precise reason this committee, that is a Bimal Jalan committee, has recommended that the accounting year for RBI should be changed from July to June to 1st of April to 31st March, which has made accounting year for both government as well as RBI the same now. And because it is same, there is no requirement of announcement of the interim dividend by RBI. This is one more recommendation of Bimal Jalan committee. Is it okay? So Bimal Jalan committee, one, it has asked to ensure that CF will fall between 5.5% to 6.5%. The CBD, Central Board of Directors, has already accepted this. It has also recommended that the total reserves which are maintained within the balance sheet will have to be within the range of 20% to 24.5%. Accepted. It has recommended that this particular framework should be reviewed after 5 years. Accepted. And finally, it has recommended that the accounting year for both the government as well as RBI are different. It should be one and the same. This also has been accepted. And remember this, currently, right, RBI follows a new accounting year principle or new accounting or financial year that will start from 1st of April and in the 31st March of next year. Done. So these are some of the very important recommendations of a Bimal Jalan committee or the Committee on Economic Capital Framework for RBI. So this is in totality the discussion about RBI. Please be very, very careful. RBI from the exams perspective, both prelims as well as mains are very, very important. Now, let's go to the next topic at hand, the issue of a bank merger that is today. What are the important points? Before discussing the concept of a nationalization of the banks, what do you mean by nationalization in the first place? There are two terms. One will refer to this as privatization, and the second one is the concept of nationalization. Okay? What is the idea here? Whenever I talk about nationalization, it simply means ownership is transferred from the private sector to the government. This is called as a nationalization. We went for nationalization of a banking sector, nationalization of a coal sector, nationalization of a civil aviation sector, nationalization of telecom sector. So earlier, before 1991, we have practiced the concept of nationalization in many of these particular industries or sectors. Why it was done? What is the impact of that? What are the problems with that? We'll have a discussion related to that later. But understand, the idea for nationalization essentially means that ownership is transferred from the private sector to the government. On the other hand, what do you mean by privatization? Exactly opposite. Now, rather than government of India owning these particular entities, government will transfer the ownership to a private company. For example, government of India going for privatization in case of Air India. Air India was owned by government of India. Now government of India wants to sell it to someone else, right? And that is a basic idea for privatization. Okay, so in case of privatization, the ownership will be transferred from the government to the private entity. And on the other hand, in case of nationalization, these particular entities, the ownership will be transferred to the government. And before 1991, we went for nationalization in case of banking sector. And post 1991, we have stopped nationalization. We are discussing privatization. We are discussing merger of these particular banks. Now, before looking at the merger, let's look at certain very important aspects related to nationalization of the banking sector. In case of India, remember this, the nationalization was conducted in two rounds. One in 1969 and the second one in 1980. Some of the books will give different years here. Do not worry about it, right? There was a problem with respect to these particular laws. In case of these particular years, do not worry about it. In certain cases, the laws were dragged to the Supreme Court or the judiciary, as a result of which different laws are formulated. That is the reason there would be a slight difference in the years given in the book. Do not worry about it. But essentially what we have done is, we have gone for nationalization in two rounds. The first round of nationalization of banking sector was conducted post 1969 and the second round of nationalization was conducted in the year 1980. And in 1969, we identified 14 banks and we went for nationalization in these particular banks. And in 1980, we identified 6 banks and we have gone for nationalization of these particular 6 banks. Now, on what basis 14 banks were identified? On what basis 6 banks were identified? For this, remember simply this, they focused on NDTL, net demand and time liabilities. In 1969, all those particular banks which had NDTL of over 50 crore rupees were identified and nationalized. And in 1980, all those particular private sector banks which had NDTL of over 200 crore rupees were identified and were nationalized. So these are the 2 important points with respect to the nationalization, which was done by Government of India before 1991. And post 1991, what has happened? We have set up a Narsimham committee, recommendations of which we will have a look at later. And this Narsimham committee recommended against going nationalization. Okay, it recommended against the concept of nationalization. That is the reason we have not gone for nationalization post 1991 in the banking sector. Now, what were the reasons? Why did we go for nationalization of these particular banks? Simply remember these particular reasons or the causes more than sufficient. First, these particular banks were owned by the private sector, and by the virtue of being owned by the private sector, their focus will be on profits. And in order to generate more and more profits, they will have to, one, collect more deposits, mobilize more deposits, issue more loans on which they are going to earn interest. And where do you think mobilization of deposits and issuance of loans will be better for a bank? In urban India or in rural India? Right, your answer should be, sir, in urban India, they'll be able to give more loans, collect more interest. They will also be able to collect more deposits. Mobilization of deposits will be much better in case of urban India. That is exactly what happened. These particular banks were focused on the profits, and again, you cannot fault them for it. These are private sector entities. So these are the private sector banks. As a result of which their focus was on profits, they concentrated their banking activities in urban India, not in rural India. And what is the problem with this? At this particular point of time, 1950s, 60s, 70s, even today, majority of the population in case of India resides in rural part of India. Is okay. Majority of the population, as per census of 2011, around 66% plus of total population in India resides in rural India. And not just this, like today, even then, huge amount of a working population was in the agriculture sector. At the time of independence, huge amount of a population, like today, was basically involved in the working in the agriculture sector itself. And please understand, to promote agriculture sector, to ensure that these particular people will get access to institutional credit, the banks will also open the branches more and more in urban India. And this was the time period when we were actually promoting green revolution in India. So to ensure all of this, government of India went for nationalization. And more importantly, understand this, in case of these particular banks, private sector banks, they want to make profit. Hence, whenever they lend, they will try to lend to businessmen in the market. They will try to lend to each other's owners. And what do you mean by this? Imagine here is a corporate entity owned bank. Let's say X. It is owned by a businessman A, right? This is a bank, and that is A is a businessman. Imagine there is another bank Y, right? And this particular bank is owned by another businessman B. Now the problem is the businessman cannot directly take the loan from X. It will become a conflict of interest. Is it okay? Because he is the owner of a bank. So obviously being the owner of a bank, he should be able to ensure that the bank will lend to the right people in the market. Bank will earn more and more profits. They will try to protect the interest of the depositors. But on the other hand, because he is a borrower, his objective is different. He wants to take a loan at a lower rate of interest. So there's a conflict of interest here. In that case, what they can do is basically lend to each other. We will get a loan from X and Y will lend to A, right? So this kind of a practice was prevalent earlier, and that is a precise reason even today RBI is categorically opposed to entry of a corporate houses in the banking sector. Because please understand, when you talk about corporate houses, there are so many subsidiaries, so many branches of this particular corporate house. And if you associate a bank with a corporate house, which is owned by this particular corporate house, there will be so many issues with respect to conflict of interest when they will start lending to each other like this. So earlier this was practiced, and when nationalized, this particular practice would be eliminated or prohibited henceforth. Right, so these are some of the reasons why Government of India went for the concept of a nationalization of the banking sector in 2 rounds, 69 and 80. Now post 1991, I've already stated we are not going for any more nationalization. Rather, in the recent times, this is being discussed. That is merger of the banks. Having larger banks in India, big banks in India. Now, idea of a big bank is very simple. Understand this. Whenever the banks are merged, let's say banks, 3-4 banks are merged like this. So this particular 3-4 banks, when merged, will create a bigger entity, and this basically is referred to as a big bank. First and foremost, the concept of a big bank was actually recommended by Narsimham Committee. But to be more precise, you cannot simply say that this was recommended by Narsimham Committee. Narsimham Committee recommended that whenever you go for a bank merger to create a big bank, ensure that strong banks will be merged to create a big bank, not weak banks along with a strong bank. Means what? Imagine there are 2 banks, X and Y. If both are strong banks in terms of, let's say, profit, in terms of, let's say, assets, if both are strong in terms of financials, go for a merger of these particular banks. Do not merge a weak bank with another weak bank or a strong bank with a weak bank. That will not lead to a creation of a big bank which is strong enough. Right, over a period of time, there is a danger that this particular bank might incur huge amount of losses and government might be forced to shut it down. So what is the recommendation here? Narsimhan Committee, no doubt, recommended that there should be a big bank in India. But the recommendation was not just 3 to 4 big banks. It also recommended that the bank mergers, right, should happen to create a big bank, and these particular mergers should be between big banks or strong banks, not between weak banks. That is the recommendation. Please remember this. Now, why is there is a discussion of so much about the big bank in India? First and foremost, whenever you talk about the big bank, the logic here is the amount of loans that will be issued by the big banks will be very, very high. Is it okay? Right? Imagine SBI. SBI is the biggest bank in India. So obviously the amount of a loan that SBI will issue, right, will be very, very high. So that is one important point. Second important point, idea of a recommendation of this particular big bank was India should not have just big banks. India should have multiple tiers like this. For example, Narasimhan committee recommended 4-tier banking structure. Right, we'll discuss that later. As of now, focus only on the 2 tiers here. The biggest, right, or at the top most, there will be big banks, 3 to 4 big banks, followed by nationalized banks, 8 to 10 nationalized banks. Okay. The logic here was very simple. Big banks will focus on lending to different types of borrowers in the market. For example, there are infrastructure developers. And why there's a connection here? In case of infrastructure developers, the logic is these infrastructure developers would want to borrow for longer duration. That's the first point. And second, would want to borrow huge amount of money. I'll repeat, these infrastructure borrowers or developers would want to borrow huge amount of money, and they would want to borrow for a longer duration. And I hope it makes sense to you, because you want to construct, let's say, a bridge or a tunnel or a national highway for that matter. Do you think the construction of these particular infrastructure projects would be over within 10 lakh rupees, 2 crore rupees, 5 crore rupees? No, these will involve thousands of crores of rupees. That's the first part. Huge amount of loans are required by these. And on the other hand, these particular loans that they want to take or the borrowing that they want to make is not for a shorter duration. It is for a longer duration. They would want to borrow for 10 years. They would want to borrow for 12 years, 15 years, etc. So these particular big lenders or big banks in the market will not be competing to acquire the same customers, such as, let's say, rural banks, such as nationalized banks. They would rather be focusing on giving loans to big borrowers in the market. And even today, this is actually required. So first advantage of having a big bank is what? One, it will lend, right, to different borrowers in the market. Lending activity is going to increase. Second advantage is it will not focus on competing with the smaller banks like this. It will try to give more loans to big borrowers such as infrastructure developers in the market. Third advantage would be these particular big banks will not only operate or provide services in India, they will also enter into international financial market, that is, enter into other countries and start providing these same kind of services in other countries. In essence, these will become much more competitive over a period of time. That's the third advantage. Fourth advantage is, as of now, what we see is these particular banks, right? Best example, State Bank of India. Right? Have a look at this. SBI today is the biggest bank in India, no doubt. But right, understand this. The problem earlier with respect to SBI was there are multiple subsidiaries of SBI. Okay, there are subsidiary bank of SBI or associate banks. Right? There was a State Bank of Mysore, State Bank of Travancore, State Bank of Patiala, State Bank of Bikaner and Jaipur. Right? So there are different associate banks of SBI. The problem with respect to having this kind of a structure is that they are concentrated in the same region. That is, in a particular city, if there's a State Bank of India branch, after 2 or 3, right, let's say shops, again there is a State Bank of Mysore. Right? After another 10 meters, there's a State Bank of Travancore branch. Opposite to that, there's a State Bank of Hyderabad. So basically what used to happen is they got concentrated. They were focused on the same type of customers in terms of, let's say, lending, in terms of mobilization of the deposits. So they were basically competing with each other within the same region. So what now Government of India says is, we will not allow that. What we'll do is we'll merge all of these associate banks with the SBI, which already has been done. Right? The earlier associate banks which were there have been merged with the SBI. First point. And there was one more bank called as Bharatiya Mahila Bank, BMB. This particular Bharatiya Mahila Bank also has been merged with the State Bank of India now. So SBI earlier itself, it was very big bank. Now it has become much bigger bank. Now what is the logic here? They will use a term called as the economies of a scale. Economies of scale. What do you mean by this? Let's take a very simple example here. Imagine this is a street in a particular city. What you would see earlier is, here is a SBI branch. After 10 meters, here is a State Bank of Mysore branch. Right? Between them, on the opposite side, there's a State Bank of Travancore. Now, when these particular branches are opened like this, can I simply say, cost of operations would be higher? Means what? For all the 3 branches, they would need certain retail space. That is, land would be required or facility would be required. So they're taking a particular building on a rent or on lease. So they will have to pay money for, right, conducting or providing these particular banking services on this particular area or this particular building as such. Second, the number of people or employees which are working. Imagine all the 3 branches, 15 members are working. So 15 into 3, 45 employees are there. And same 45 employees are providing services to, let's say, 10,000 customers. Right? Now what Government of India says? All of this not required. I will take a State Bank of Mysore, merge it here. I will take a State Bank of Travancore, merge it. So rather than having 3 branches, now I would require only 1 branch. And what is the advantage here? 1 branch means what? The real estate cost, rent, will come down. Number of people who are working here, right, earlier were 45, now 45 will not be required. The resources such as, let's say, technological resources, that is systems, servers, right, etc. Resources will get pulled, right? So a cost of operations, cost of expenditure will start coming down. Is that okay? Cost of operations will start coming down. This is essentially nothing but economies of scale. And as a result of closure of 2 branches, now can I open the same 2 branches somewhere else where the banking services have not yet reached? So reach will increase, cost of operations will come down, resources can be pooled, economies of scale can be used. In addition to this, what are the advantages of a big bank? I've already discussed. Okay. Now, having seen the good outcomes that we are expecting or the objectives that we want to achieve with the concept of a big bank, what are the concerns? What are the issues associated with a big bank? First one, understand this. It is not sufficient to have only one big bank or two big banks. You need to have multiple big banks. Why? If you take the recommendation of Narsimham committee itself, it recommended 3 to 4 big banks or large banks. You cannot have only one big bank and all the other normal banks or smaller banks. As a result of this, what will happen is this particular big bank will start competing with these particular smaller banks. For example, Canara Bank competing with the SBI, the Karnataka Bank competing with the SBI, or other regional banks competing with the SBI. SBI is a very, very big bank. Right? Can these particular smaller banks continue to compete with them? Right? That creates a certain problems in the economy. Then, so need to have multiple big banks, and you need to ensure that whenever the mergers of the banks are done, strong banks are merged with the strong banks. Okay? Obviously, employees will be worried. What is the issue here? Employees are provided with certain benefits. Employees are guaranteed certain salary. Now, what if two banks, Bank A and Bank B, are merged? The work culture of both of them are completely different. Right? Salaries for the employees are completely different. Now, what will you do when you merge these two entities? Can you have a different work culture amongst two employees of the same bank now? That creates inefficiency. That creates frictions within the banking sector. Let me give a very simple example here. Right? If you talk about Air India, earlier this Air India was basically two different companies. One, as usual, there was Air India, and the second one, there was Indian Airlines. Now, the idea there was, for one company, there were 5 working days, and for another company, there were 6 working days. In one company, salaries were higher. In another company, salaries were comparatively lower. In one company, promotions were guaranteed. In another company, after 6 to 7 years, may be promoted. Now, you merged both of these entities. Now, can you have a different work culture amongst the employees of the same company? So that created a certain inefficiency in the whole system. Right? That is also one of the reasons why this particular company, Air India, after the merger, continued to incur huge amount of losses. Done? So have a look at this. When you merge these particular entities, you will have to ensure that there's a harmonized system of work culture, harmonized system of, let's say, payments, etc. Right? Otherwise, frictions could get created. And the third very important concern with respect to the idea of a big bank is, understand this, as of now, when Bank A wants to lend to a particular company, is it okay? Let's assume there's a company XYZ. The company XYZ wants to borrow 1,000 crore rupees. Rather than only A bank lending it, there's a concept of consortium lending. Is okay? There's a concept of consortium lending. What do you mean by consortium lending? Only one bank will not lend to the company here, right? 2 or 3 banks like this or more banks will come together, will evaluate the proposal and will give a loan of 1,000 crore rupees to this particular company. And what is the advantage here? The advantage is the risk is not taken by a single bank. Is it okay? There's a term called as a concentration risk. What do you mean by concentration risk? Imagine all the 1,000 crore rupees given by only one bank. Don't you think if the company XYZ fails, if the company XYZ incurs huge amount of losses and shuts down, right, only Bank A will suffer then, right? Because only bank has given a loan to this particular company XYZ. Rather than this concentration risk, what we are trying to do here is, through consortium lending, we are reducing the concentration risk. Now, let's say Bank A provides 300 crore rupees loan to company X out of 1,000, right? Bank B will provide 500 crores, Bank C will provide 200 crores. So earlier, only one bank would have incurred a huge concentration risk. And now, rather than one bank having a concentration risk, now it is divided amongst the 3 banks based on the proportion of the lending that they have done. So having a consortium lending, right, is good if you are worried about the concentration risk. Or what you are focused on, when you are talking about a big bank, they will lend to, let's say, infrastructure developers. They will lend to long-term borrowers in the market. And imagine one big bank, right, Bank A lends huge amount of money, let's say 2,000 crore rupees for a manufacturer in the market, and this particular manufacturer incurs a loss, shuts down the company. Don't you think the Bank A is having a huge concentration risk here? Definitely yes. So in case of a big banks, there will be concentration risk. In case of the current situation in the banking sector, rather than one bank lending complete amount of money, there is a concept of a consortium lending. We are not having a concentration risk because of the consortium lending, right? So in case of a big bank, that will definitely become a concern. And another very important concern is the concept of a spillover or contagion effect. What do you mean by a spillover effect or a contagion effect? Follow this very carefully. Spillover or contagion basically refers to a situation wherein one event which, right, is unrelated to another country is taking place. Is it okay? One event in a particular country or in a particular segment of the economy, etc., is taking place. But because of this particular event, the effect of this is also felt on the other economy or other sectors of economy. I'll repeat it. There is an event which is taking place. The effect of this event will be felt in another part of the economy or another country, though both of them are unrelated. Let me give a simple example so that you will understand. Imagine, right, there are 2 countries, country A and country B. There is a huge amount of exports which are happening from country A to country B. Now, what if the economy of country B enters into recession? Is it okay? The B's economy or the country B's economy falls into slowdown, enters into recession or falls into depression. Now, the depression or recession is happening in country B. It is nowhere related to country A. It is happening in country B. But can I simply say that because there is a recession in country B or a depression in country B, the amount of exports that will enter from A to B will get affected. Because in country B, manufacturing will be affected. Consumption will be affected. Now, do you think the same amount of exports will keep on flowing from country A to country B? No. Now, the exports of country A will also get affected. Now, imagine there is a manufacturer in country A who was exporting to country B. His exports will become very low or will altogether get stopped. As a result of this, what will happen? He has to fire some of the employees. He has to remove some of the employees. He will have to reduce the production. He will have to reduce the amount of raw material that he was purchasing. As a result of this, the vendor or the supplier who was supplying raw material to the manufacturer, his business will also get affected. This is called as a spillover effect or a contagion effect. And whenever you talk about a big bank, there is always a concern that what if there's a very big bank in a particular economy and this particular big bank fails? Is it okay? What if there's a big bank and this particular big bank fails? For example, again, this is just an example, right? It is not happening. Imagine a situation wherein SBI will file for bankruptcy. One fine day, you're watching news and suddenly the news appears saying that SBI is shutting down. SBI is incurring a huge amount of a loss. It is shutting down. Again, I'm giving this as a hypothetical example. It has not yet happened. So have a look at this. SBI, right, enters into bankruptcy. It will shut down. Don't you think the impact of that will be very huge on the overall economy? Because SBI is one of the biggest banks in terms of number of branches, in terms of deposits that have collected, in terms of a lending activity. So such a big bank will close down. And can you imagine what kind of impact it will have on the whole banking sector? The borrowing segment, such as manufacturers, housing segment, right, which would be borrowing to, let's say, develop the real estate, etc. So because of the big bank, if the big bank fails, then definitely yes, there would be certain impact on the whole economy. So having smaller banks, imagine there are hundreds of banks in India. Some small bank fails. Will it create a ripple effect? Will it have certain impact? Definitely yes. Any failure of a bank is bad. I understand this. I'm not saying that let the small banks fail. I'm simply saying if there are two options. Option A, one small bank failing, and option B, very big bank failing. Out of two, right, B will create a much bigger impact on the economy compared to A. Of the two, both are bad. Of the two, which will be much more bad? A big bank failing, right, is much more bad compared to a very small bank failing. So currently, we have number of small banks like this. Government of India is merging these particular small banks, creating a big bank. And if this particular big bank fails, then it will create much bigger problem compared to earlier situation where, let's say, a small bank would have failed. Done? So these are some of the issues with respect to big bank. Now, has RBI taken any measure to address this particular issue? Definitely yes. Remember this also. RBI has introduced a concept called as systemically important banks. Is it okay? DSIB, domestic systemically important bank. Okay, DSIB stands for domestic systemically important bank. Multiple banks such as HDFC, ICICI Bank, SBI, etc. have been identified by RBI as a DSIB. And on what basis a bank would be identified as a DSIB or recognized as a DSIB? Whenever bank's assets cross more than 2% of GDP value. Is it okay? Imagine GDP is 100 crore, 2% of GDP will be how much? 2 crore. So if a bank's assets cross more than 2 crore rupees, then RBI says I will classify this, notify this bank as a DSIB, domestic systemically important bank. And please understand, RBI is not the first entity in the world to do this. In fact, even before DSIB, which was introduced post 2015 in India, there was a concept of a GSIB, Global Systemic Important Banks. Based on the model of a GSIB, we have introduced a DSIB in India. And what happens if you are identified as a DSIB? RBI will impose more restrictions on you. Remember this, right? The guidelines, regulations which are applicable to all the banks will not be applicable to you. Rather, these particular restrictions will be much more stringent, much more strict in the context of these particular DSIBs. Why? RBI says, I do not want to allow these particular banks to fail. These are very, very important for the economy. I do not want to allow the banks to fail. Hence, what I'll do, I will regulate them much better. I will regulate them under much stricter norms. That is the first point. Second point, in case of a DSIB, if this particular DSIB or a bank within DSIB category, imagine it is failing, right? There are certain concerns with respect to viability of the bank. In such cases, they might expect assistance from the government. Is it okay? In case the financials of the bank are dwindling, the bank is continuously incurring losses, it is in a crisis. In such cases, they might expect assistance from Government of India. Why? Even Government of India says, I do not want to allow this particular bank to fail. It is very, very important for the economy. Done? So the concept of a DSIB has been introduced by RBI to regulate these particular banks, which are very, very important for the system or the whole economy as such. So this is a discussion with respect to the concept of a big bank or idea of a bank merger. And in recent times, yes, Government of India has been merging multiple banks to form big banks. For example, 10 public sector banks have been merged to form 4 PSBs. Right? Earlier, associate banks as well as a Bharatiya Mahila Bank has been merged with SBI. Right? Dena Bank, Vijaya Bank were merged with the Bank of Baroda. So the Government of India has been going on consolidating this particular banking sector and creating these particular big banks. And so this is a discussion overall with respect to idea of a big bank.